Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So today's topic, I would like to discuss about few critical thinking questions and how to find solutions in real life scenario. So after going through this topic, the learner will be able to identify the solutions to critical thinking questions with reference to real life situations and understand accounting concepts. Let us start with the first one. Define account, illustrate different types of accounts and principles of accounts. Means here I am going to discuss about the rules of debit and credit. So let us begin with the definition of account. An account is a record in the general ledger that is used to collect and store debit and credit amounts. Accounts are a fundamental part of an accounting system and are used to track various types of transactions. They provide a systematic way to record the financial activities of a business or individual. Types of accounts. Accounts can be broadly categorized into three main types: real accounts, personal accounts, and nominal accounts. So, real accounts means these accounts relate to assets and liabilities which are permanent accounts. They do not get closed at the end of the accounting period and are carried forward to the next period. For example, cash, accounts receivable, buildings, and equipment. Personal accounts means these accounts relate to individuals, firms, companies, or organizations. So they can be further divided into two types: natural personal accounts, artificial personal accounts. Natural personal accounts related to individuals, example, John Doe's account. Artificial personal accounts relate to entities like XYZ Limited Companies account, ABC Limited account, etc. Representative personal accounts. Accounts representing a group of people or certain individuals. Example, outstanding salary account. The next type is nominal accounts. These accounts relate to expenses, losses, incomes, and gains. They are temporary accounts that are closed at the end of the accounting period. These examples include like rent expense, salary expense, sales revenue, and interest income. Coming to the principles of account, which are also denoted as rules of debit and credit. The rules of debit and credit are fundamental to the double entry bookkeeping system. These rules are based on the type of account being used and help ensure that the accounting equation assets is equal to liabilities plus equity remains balanced. So coming to the rules for real accounts. Debit what comes in, credit what goes out. Example, purchase of equipment for cash. So as equipment is an asset that comes into the organization, so that is the reason we are going to debit equipment account, and credit means what goes out. In return, as you have purchased an equipment by cash, so cash goes out. So credit cash account. Coming to rules for personal accounts, debit the receiver, credit the giver. For example, receiving payment from a customer. So as here debit the receiver, the company is going to receive cash from the customer. So as a result, debit cash account and credit customer's account. The same amount it is uh, going out of the customer's account in the form of bills payment. Then rules for nominal accounts: debit all expenses and losses, credit all incomes and gains. Example, paying rent. So rent is an expense. So as a result, we have to debit rent expense account. And how we paid the rent, that is in the form of cash. As a result, credit cash account. So let us discuss the same accounting types along with the rules by using some kind of examples. Real account. Buying office furniture for cash. See, as we know, the rule of real account is debit what comes in, credit what goes out. As furniture is an asset to the organization, so we have to debit office furniture and credit cash. Coming to personal account, receiving a loan from the bank, debit the giver, credit the receiver. So debit the cash and credit bank loan because bank is the giver and we are the receivers. Then nominal account, earning interest on a savings account. So according to this, debit bank interest received, which is income, and credit interest income. That is also income, but it is an expense. And summary, understanding the types and principles of accounts along with the rules of debit and credit is essential for maintaining accurate and balanced financial records. These fundamentals form the backbone of double entry accounting system, ensuring every financial transaction is properly recorded and tracked. Then describe the concept of double entry system. Describe advantages and disadvantages of double entry system. So concept of double entry system, it is a fundamental accounting concept where every financial transaction affect at least two accounts, ensuring that the accounting equation assets is equal to liabilities plus equity. It remains balanced. This system requires that for every debit entry, there must be a corresponding credit entry of an equal amount and vice versa. This method provides a complete record of financial transaction, facilitating accurate financial reporting and analysis. So, coming to the basic principles of double entry bookkeeping system, the first one is dual aspect. So, according to this principle, every transaction has two aspects. One is a debit, other is a credit. Then equal debits and credits. The total amount debited must always equal the total amount credited. The next accounting equation. The double entry system helps maintain the balance in the accounting equation. Assets is equal to liabilities plus equity. For example, if a business purchases office supplies for $500 on credit, debit office supplies as it is an asset worth $500 and credit accounts payable, which is a liability, and the same amount should be shown on credit side. Advantages of double entry system. The first one is accurate financial records. So ensures that all transactions are accurately recorded with both their aspects leading to a precise financial statements. Then it can also helpful in detecting error detection. So makes it easier to identify and correct errors since the total debits and credits must always balance. Then comprehensive financial information. It provides detailed information about the financial transactions aiding in decision making. Then next, financial control. So it also helps in maintaining control over financial activities, allowing for better management of resources. Next, legal compliance. It meets the requirements of various legal and regulatory frameworks, which often mandate the use of the double entry system for financial reporting. Coming to preparation of financial statements, it also facilitates the preparation of accurate financial statements such as balance sheet, income statement, and cash flow statement, etc. So apart from advantages, it also have some kind of disadvantages with double entry system. The first one is complexity. It can be complex and time consuming, especially for small businesses with limited accounting knowledge. And it is costly. It may require specialized accounting software and trained personnel, leading to higher cost. Then prone to fraud. While it helps detect errors, it can still be manipulated to conceal fraud if not properly monitored. Then it requires consistency, needs consistent and diligent recording of transactions to maintain accuracy, and which can be a challenging task to the organization. And detailed records. The necessity of maintaining detailed records for all transactions can be cumbersome and require significant effort. So, the double entry system is a cornerstone of modern accounting, providing a robust framework for recording financial transactions. Its advantages, such as accuracy, error detection, comprehensive financial information, make it an essential tool for businesses. However, its complexity, cost, and need for diligent record keeping can pose challenges, particularly for smaller entities. Despite of these disadvantages, the benefits of using the double entry system generally outweigh the drawbacks, making it a preferred method for accounting worldwide. Then outline the significance of trial balance, sketch different methods of preparing trial balance. So first, focus on the significance of trial balance. So before going to find out the significance, first of all, we'll see what is a trial balance. A trial balance is a bookkeeping worksheet in which the balances of all ledgers are compiled into debit and credit columns. It serves several significant purposes. The first one is verification of ledger accounts. So it ensures that all debits and credits from the ledger accounts are accurately recorded. Next, error detection. It helps identify and rectify any errors in the ledger accounts, such as entries that do not balance. Then, financial statement preparation. So, it acts as a preliminary step in preparing financial statements like the balance sheet and income statement. So, before going to prepare the final accounts, every accountant they will prepare the statement of trial balance so that they can able to detect in case of any errors occur while recording and maintaining the records. Then consistency check provides a snapshot of all account balances at a specific point in time, ensuring consistency in financial records. So it means that they can able to record the day-to-day transactions in a chronological order, and the same transactions should be posted into various ledgers. Then accounting accuracy, it confirms that the accounting entries are mathematically correct, reinforcing the accuracy of financial records. Then coming to the methods of preparing trial balance, basically we have three types of methods for preparing a trial balance. The first one is the total method, second one is balance method, and the third one is compound method. So let us start with total method. In the total method, the total debits and credits of each account are listed. The totals of debit and credit columns are then summed and compared. So the steps involved in this method are: list each account with its total debit amount in the debit column, list each account with its total credit amount in the credit column, sum the total debit and credit columns to ensure they match with each other. So this is the example here: account name, debit total and credit total. So whatever available transactions that we have to listed in the accounts name, cash account, accounts receivables, accounts payable, sales revenue, expenses, then find out the total. So as cash is an asset that should be entered on debit side, accounts receivable also an asset, so that should be mentioned on debit side, whereas account payable liability, so credit side, sales revenue as income, credit side, coming to expenses, debit side. Then total debit side items and credit. So as in this result, we can have the same total. One side we are lagging with other. So if there is uh, a balance of 4,000, if you total these two, so 4,000 is balanced. So that should be added on the credit side so that we can make the total same on both the sides. Then second one is balance method. In the balance method, only the balances of the accounts, which means the difference between the total debits and credits are listed in the trial balance. Then the steps involved in this method is, first of all, we have to calculate the balance of each account, total debits minus total credits, and list the balance of each account in the appropriate debit or credit column. So sum the debit and credit columns to ensure their balance. So the same example also here I have shown, and that should be maintained separately. The third one is compound method. So compound method combines both the total method and the balance method. So it shows both the totals and the balances of each account. The steps involved in this method are: list each account with its total debit and credit amounts. Second, calculate the balance of each account and list it in the appropriate column. And whereas third, sum the debit and credit columns to ensure the balance. So the pro forma will be like this: account name, debit total, credit total, debit balance, credit balance. The trial balance is an essential tool in the accounting process, providing a way to verify the accuracy of ledger accounts and aiding in the preparation of financial statements. By employing methods such as the total method, balance method, and compound method, accountants can ensure that the financial records are balanced and free from errors, thereby maintaining the integrity of financial reporting process. Next, explain the importance of trading account, illustrate the significance of profit and loss account. Coming to the importance of trading account, the trading account is a financial statement that summarizes the revenue and expenses directly associated with the sale of goods or services. It is primarily used to determine the gross profit or loss of a business over a specific period. Gross profit calculation should be done by subtracting the cost of goods sold COGS from the total sales revenue. The trading account calculates the gross profit. So this helps in assessing the basic profitability of the company's core operations, excluding their operational expenses. Operational efficiency. It provides insight into the efficiency of the production process and cost management. If the gross profit is declining, it might indicate issues with production cost or pricing strategies. Cost management. By analyzing trading account, businesses can identify and manage costs better, ensuring that the production or procurement expenses do not exceed the revenue generated. Decision making. It helps in making informed decisions about pricing strategies, cost control, and inventory management. Next, profit and loss account. The significance of profit and loss account are comprehensive profitability. The profit and loss account provides a broader view of a company's profitability by including all operating and non operating revenues and expenses. This includes not only the gross profit from the trading account but also operating expenses, taxes, and other income and expenses. Net profit or net loss calculation. So it also shows the net profit or loss for a period, which is crucial for evaluating the overall financial performance. So, net profit reflects the company's ability to generate profit after all expenses are accounted for. Next, performance measurement. It helps in measuring the performance of the business over a specific period, providing a clear picture of operational efficiency, cost management, and revenue generation. Financial analysis. Investors, creditors, and management use the profit and loss account to analyze the financial health of the business. It helps in assessing profitability trends, operational efficiency, and financial stability. Strategic planning. By understanding the components of profit and loss account, businesses can plan future strategies, including budgeting, forecasting, and financial planning. Let us take one illustration. Imagine a retail company that sells clothes. The trading account for this company would include sales revenue, the total amount earned from selling clothes, cost of goods sold, the total cost of purchasing or manufacturing the clothes. The trading account would calculate the gross profit as follows: gross profit is equal to sales revenue minus cost of goods sold. The profit and loss account would include gross profit from the trading account. Operating expenses that includes here salaries, rent, utilities, etc. And whereas coming to non-operating income or expenses, interest income, interest expenses, etc. Coming to the taxes, income tax applicable, the profit and loss account would calculate the net profit or loss as follows. Net profit or loss is equal to gross profit minus operating expenses minus non-operating expenses plus the non-operating income minus taxes. So whatever amount we used to get, if you get a positive value, then that should be considered as net profit. If you get negative, it should be considered as net loss. In summary, the trading account is crucial for understanding the core operational performance, while the profit and loss account provides a complete view of the company's overall financial performance. Thank you.
Like, share, and subscribe. Hit the bell icon for more updates.